Ladies and gentlemen, good day and welcome to the Q4 FY24 result conference call of the Phoenix Mills Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. Today, we have with us Mr. Shishir Srivastava, Managing Director, Mr. Kailash Gupta, Group CFO, and Mr. Varun Parwal, Group President, Strategy, Internal Audit, and Head Corporate Finance. I now hand the conference over to Mr. Shishir Srivastava. Thank you, and over to you, sir.
Good morning, ladies and gentlemen. I take pleasure in welcoming you all to discuss the operating and financial performance for the fourth quarter and year ended March 2024. However, before we proceed, I am very pleased to welcome Mr. Kailash Gupta as the company's Group CFO. Kailash brings over 25 years of experience across various financial disciplines, including business strategy, investor relations, M&A, financial planning and analysis, treasury and taxation, to name a few. Most recently, Kailash served as the CFO at Inox Leisure Limited for 8 years, leading their financial and commercial operations. He played a key role in the merger of Inox with PVR Limited. Prior to Inox, Kailash held significant positions at Torrent Pharma, Entertainment Network, Thomas Cook, Tata Teleservices, and the Aditya Birla Group. Kailash is a qualified chartered accountant from the batch of 1995 with a well-proven track record. He has received several accolades, including the CA-CFO Award for Media and Entertainment Industry from the ICAI, and was also recognized as one of Asia's 100 power leaders in finance by White Page International. We are confident that his expertise will be instrumental in our continued growth and performance. I will now take you through the key highlights of the results with reference to the relevant slides of the results presentation. If I may draw your attention to slide 3. Starting off with a quick overview of the retail business. FY24 has been a milestone year for the business. At the start of this financial year, we had set sights on stabilizing the 4 new malls and driving growth across the existing operational assets. I'm very pleased to report that we had a strong operating performance across most centers, and consumption or retailer sales at our malls for the year closed at rupees 11,344 crore, up 23% year-on-year. Moving on to slide 4. This slide provides a breakup of the performance and highlights the contribution from new malls during FY24. EBITDA from the retail business for the full year came in at rupees 1,672 crore, up 25% year-on-year. Overall, existing operational malls saw full year rental income and EBITDA growing at about 6% and 7% respectively. EBITDA margin as a percentage of rental income is at a healthy 104% of rental income. New malls contributed approximately 295 crore in rental income and approximately 256 crore in EBITDA for FY24. EBITDA margin as a percentage of rental income is lower in new malls during the initial period of occupancy ramp-up. However, going forward in FY25, EBITDA margins from new malls should start moving towards the margins we see for our existing operational malls as these malls stabilize. Let's go to slide 5. We are seeing a fast ramp-up in the trading occupancy at our newly launched malls. Phoenix Citadel Indore, launched in December 2022, crossed 90% occupancy levels within 12 months of launch and has been trading at a stable 91% occupancy still since then. Palladium Ahmedabad launched in February 2023. This is on slide 6. It's already trading at 86%. In fact, the multiplex at Ahmedabad is ready, and once we obtain the occupation certificate, the multiplex will commence operations and the occupancy level will cross 94%. Moving on to slide 7, Phoenix Mall of the Millennium at Pune opened up opened in September 2023 and is already trading at 77% occupancy levels within 8 months of opening. And on slide 8, last but not the least, Phoenix Mall of Asia at Bangalore launched in October 2023 and is already at 67% occupancy levels within 6 months of opening. Let's take a look at slide 10. As we have noted earlier, total consumption in FY24 was at rupees 11,344 crore approximately, demonstrating a year-on-year growth of 23% over FY23. On a like-to-like basis, consumption in FY24 grew by 8% over FY23, led by strong double-digit growth in Phoenix Market City and Palladium Chennai, Phoenix Market City Mumbai at Kurla, and Phoenix Palacio Lucknow. Phoenix Palladium reported a growth of 4%, but if adjusted for the loss of contribution from the lifestyle store, it reported consumption growth will be approximately 9% on a like-to-like basis. As you may all be aware, we have shut down that store and demolished that structure as per our revised approval plans to provide a spectacular entry and arrival experience and better circulation for the ever-growing, iconic Phoenix Palladium development. Gross retail collections for the period were approximately 2,743 crore, up 27% over FY23. Slide 11 shows total consumption in quarter 4 FY24 was at approximately 2,833 crore, up 28% year-on-year, and on a like-to-like basis grew by 10% over Q4 FY23. This is excluding the new malls which were launched in the end of calendar year 23. Slide 12 provides an overview of the category-wise consumption performance across our malls on a like-to-like basis. Moving on to slide 13, rental income for the quarter grew by 31% over Q4 FY23, driven by strong performances from Phoenix Market City, Pune, Phoenix Market Cities in Mumbai, Chennai, and Phoenix Palacio, Lucknow. The rental income performance is reflected in the EBITDA performance as well, and on slide 14, it demonstrates a growth of 28% over Q4 FY23. Drawing your attention to slides 15 and 16, since we have discussed the FY24 retail income and EBITDA performance, I will skip through these slides and go to the occupancy overview across major malls on slide 17. Weighted average leased occupancy across major malls stood at 97% and trading occupancy at 88%. Moving on to the commercial office section, which is on slide 18, we have taken significant strides towards cementing our presence in this asset class as well. Slide 19 demonstrates that for FY24, total income from the office business was approximately 190 crore with an EBITDA of approximately 110 crore, depicting a growth of 12 and 13% respectively over FY23. FY24 gross leasing has been over 500,000 square feet, out of which approximately 3.6 lakh square feet is new leasing and 1.7 lakh square feet is renewals. Slide number 20. Occupancy in our operational portfolio of Mumbai and Pune has increased to 70% at the end of FY24, up from 63% last year, while maintaining healthy gross rental levels. On slides 21 and 22, in line with the performance in FY24, income from the office business in Q4 FY24 was at 49 crore, up 13% compared to the same quarter last year. And EBITDA was rupees 30 crore, up 12% over Q4 FY23. We are hopeful to continue this momentum with the launch of best-in-class benchmark setting new age commercial office assets at Bangalore, Pune and Chennai in 2024, where we have seen keen interest from prospective clients. Moving on to slide number 23 and the hotel assets, we continue to see positive trends in the hospitality segment with double-digit growth in ARRs along with high occupancy levels in both of our operational hotels. Slide 24 shows that our marquee destination, the St. Regis Mumbai, we have seen a remarkable ARR level at more than 21,000 in Q4 FY24. Even for the full year of FY24, there has been a notable increase of 23% in room rates while maintaining above 80% occupancy throughout the year. Coming to the operational performance shown on slide 25, St. Regis continues to reach new heights and has clocked total income of over 490 crore with EBITDA of approximately 223 crore, representing an impressive EBITDA margin of 46%. Slides 26 and 27. Moving on to the Courtyard by Marriott at Agra. We have seen double-digit ARR growth throughout the year with occupancy levels close to 80%. The operational performance, this asset has clocked a total income of 55 crore with EBITDA of 16 crore and healthy margins of 29%. Let's move to the residential business, which is on slide 28 and onwards. We've had another remarkable year during FY24. Slide 29 and 30 show a strong demand and fast conversion, where we've seen gross sales of approximately 566 crore, and we've collected 646 crore during FY24. Also, we are happy to report that we have received the occupation certificate for Tower 7 at One Bangalore West. Accordingly, basis sale of the completed inventory and on receipt of OC of Tower 7, we have recognized revenue of 870 crore for FY24 and 454 crore during the last quarter. Moving on to the financial results for the quarter and year ended 31st March 2024. This is on slide 31 and onwards. Slide 32 shows the standalone P&L, which houses Phoenix Palladium Mumbai and a very small component of offices Phoenix House. Income from operations for Q4 FY24 and full year FY24 have been slightly lower than Q4 FY23 and full year FY23 as well. Mainly on account of ongoing enhancements to the overall layout, where we have vacated and demolished the structure which housed the lifestyle store previously, and that has had an impact both on consumption and on our rental incomes. Without spending too much time on the standalone balance sheet, we will move on to the consolidated performance. On slide number 34, with addition of new operational assets and momentum in leasing and occupancy, our income from operations for Q4 FY24 is higher by almost 80% compared to Q4 FY23. For the full year of FY24, income from operations is higher by about 50% compared to FY23. I would like to mention at this point that in FY24 we have booked 870 crore of revenue in our residential business, which has been added to this, and this demonstrates a boost in the top line. On our operating EBITDA metrics for the full year FY24, we have reported 2,185 crore with an increase of 44% over FY23. This momentum has been seen quarter on quarter with Q4 FY24 clocking 46% growth in operating EBITDA over Q4 FY23. Profit after tax after adjustment of minority interest and exceptional items, which was rupees 1,152 crore for FY24, grew by over 60% over FY23. Let's move on to the consolidated balance sheet. which has granular numbers. Slide number 36. Our consolidated debt as on 31st March 24 is rupees 4,366 crore with an average cost of roughly 8.8%. Let's draw your attention to slides 37 and 38. On the consolidated cash flows front, we have crossed the milestone of rupees 2,000 crore and generated net cash flow from operations of rupees 2,162 crore net of taxes. We have reinvested considerable amount of this cash flow through capital expenditure across assets under development and one land acquisition during the year, in total aggregating about 1,670 crore. Just for perspective, after removing interest paid to service the existing debt, our operating free cash flow net of taxes and interest is about 1,781 crore for FY24, which is 27% higher than last year. Slides 39 and slides 40 show our group level net debt position has remained close to rupees 2,200 crore as majority of our capex has been funded by operational cash flows. PML level net debt position has improved with net debt of 1,560 crore as on 31st March 2024. Let's move on to slide 41. Last month in April, we have acquired 6.6 acres of land adjacent to Phoenix Market City, Bangalore at a cost of about 230 crore. This has been acquired through a joint venture with Canada Pension Plan and will add to the overall footprint and development potential, accessibility and experience for our destination retail-led mixed-use development, Phoenix Market City, located on Whitefield Road in Bangalore. On slide 42, we have a clear roadmap of where we intend to be by 2027. We aim to have an operational portfolio of about 14 million square feet of retail, 7 million square feet of offices, close to 1,000 keys in hotels, and add another million square feet to our residential development. These are all projects which are already underway. Lands have been acquired, and we may be under construction or at design development stage. As we have seen on the earlier slide, we are busy charting our growth beyond 2027 and have added to our development mix through land acquisitions at Thane and Bangalore. And we continue to evaluate and work on opportunities selectively to add to our growing portfolio. Moving on to sustainability, slides 43 and 44. Sustainability is very important focus for our company. As we grow, we are committed to doing so responsibly, and here's how. We are amping up our use of renewable power across our entire portfolio, aiming for over 70%. All our new buildings are targeted to be LEED certified, ensuring they are environmentally friendly and efficient. We are already making strides on this front with one-third of our existing retail buildings, one-third by GLA, are already certified with a USGBC LEED certification. This brings me to the end of our operational and financial performance update, and we can now be open for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking the question. Ladies and gentlemen, we will wait for the moment while the question queue assembles. First question is from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Hi, Shishir. Congratulations on a great quarter, sir. Shishir, my first question is on the same-store growth of 8%. So if you can help us understand a little bit more on how has been the trading occupancy impact on this 8% volume growth and inflation.
Thanks for your question, Parikshit. Let me try and answer it to the best of my abilities. If you look at our operating assets, several of our Phoenix market cities continue to be at the lag end of the tenure with anchors. So, for example, Phoenix Market City, Bangalore, and Phoenix Market City, Mumbai, are about Phoenix Market City, Pune. Both have anchor space, which is about more than 52%. During the cycle of the mall's life or the tenure of the contracts, we continue to see opportunities to make these malls more efficient. What I mean by that is moving away from being anchor heavy, depending on where you are in the life of that mall, what the customer aspirations are, and bringing in a new brand mix and perhaps new categories. So we did this in Phoenix Market City, Mumbai, and we've seen a significant, I would say in one and a half years, the numbers have played out and they demonstrate how this strategy has worked for us. So in several of our malls, we are now seeing that opportunity again in the next year and maybe year and a half. So that strategy will help boost consumption. So it's always important to refresh the category mix and brand mix. I think we took some hit at Lower Parel, as I mentioned during my notes, during my opening remarks, that with the lifestyle block being, which generated close to 25-27 crore annual rent and significant consumption, we saw a drop in consumption and rent because the lifestyle block was vacated and demolished to create a better experience for the ongoing development. We are doing some fantastic work at Phoenix Palladium, Mumbai in expansion. There is a host of new brands that we are in discussions with. These are definitely going to, aid in improving both consumption and overall rental income for us. So I don't think we are seeing any structural issue here, which is causing consumption, to let's say be at a stable, consistent level or not demonstrate great growth. I think it's every mall in its life is has this opportunity of improvements every 3 to 5 years, and that's where we are in with several of our malls. So I think we're going to see this getting better.
So any guidance for next year? What kind of same-store sales growth you're looking at?
Sorry, Parikshit, can you repeat what you're saying?
So for these malls which are like operational, like-to-like basis, what kind of growth do you think we can forecast for FY25 versus 8% we have reported this year?
See, I don't think it's fair to talk about FY25 alone. I would say one has to always look at a 3-year CAGR and 3 to 5 year CAGR, and over a 3 to 5 year CAGR, I would estimate anywhere between 11-12% kind of a growth. Okay.
So my second question is on Thane. So when you have acquired the land parcel, so any plans like what have you decided to do there? One of your competitors coming up with a hotel on 560 odd rooms, keys. So any plans? What are you looking to add there, do there? In terms of, you can help us in the mix, understand resi, commercial, hospitalities, what you intend to do there?
Yeah, I think, we're not ready to announce what we're doing there yet because it's still not concluded. So we're going to take probably another 2-3 months to perhaps decide. But it's seeming to be a large mixed-use development with a combination of maybe some retail, some hotel. We are trying to really determine if resi is the right way to go. I think that's where the question really is, what's the best use on this land. So we will be very, very happy to announce as soon as we've taken a decision.
Okay. And just last thing on the residential piece. So now we have said that I think we are increasing our overall developable area there by FY27. So what kind of pre-sales number do you think we can achieve on a more consistent and a steady basis so that portfolio gives more visibility on growth? So we didn't have any major launches besides the Bangalore one. I think Alipur is still awaited. So how do you intend to build that portfolio over the next 3-4 years, and what kind of pre-sales do you think you can achieve in that segment, say, in 3 years' time? More on the roadmap of 3 years, next 3 years there.
In Calcutta, we've secured the major approvals. This is going to be about 1 million odd square feet of saleable area, right? We are waiting. We've applied for EC, so we are in the process of getting the approvals. I think we may be about 6 to 8 months away from launch on this asset. Okay. The micro market there seems to be very, very strong and stable. Our primary research is showing rates in that micro market to be in excess of about 18,000-20,000. We've already decided on what the product mix is going to be like in terms of the sizing of the apartments, configuration, etc. We have about 350 to 400 crores as our target in this year to sell the ready inventory which we have in Bangalore between One Bangalore West and Kisaku. So I think that's a great target for us to chase another 400 crore this year. We have total ready inventory is about 1,200 crore, of which in this year we are targeting about 400. We'll certainly work harder to deliver more than our target. We've taken some price hikes, and the market has also accepted that well. And we're selling at about 24,000 rupees per square foot plus compared to 15,000 plus in 2019. I think this would be our guidance for FY25, that we're targeting to get aim to sell about 400 crore.
Okay, and more on the longer term, like 3-4 years, what kind of sales can this segment do for us, like residential? Can we reach that 2,000 crore number with the addition of more projects over the next 2-3 years?
So currently we don't have any active plans on expanding on residential, for example. We're not in any race to become, a large residential developer. We are being very selective about the opportunities, and depending on, the value at which we are able to buy land in mature, stable markets where absorption has been consistent, we will continue to look at those opportunities. But I can clarify that today we are not actively looking at any residential growth, new projects.
Okay, sir. Sure. Thank you, and I wish you all the best. Those were my questions.
Thank you very much. The next question is from the line of Praveen Chaudhary from Morgan Stanley. Please go ahead.
Hi. Thanks so much for taking my call, and congratulations on a very, very good result. Hi, Shirish. Just a quick question for me. Can you talk about the competition in Tier 1 existing cities where you already have malls in terms of, are you finding, considering how good this business has been, credible competition coming in? And the second question is on Tier 2 cities. The return on invested capital, how are you thinking about it as you're going into newer cities? So far you have obviously achieved that, but are you finding that you may not be, or you need to slow down if the returns are coming slower? How are you thinking about it is the question. Thank you.
Thanks, Praveen. So let's talk about Tier 1 cities and competition in Tier 1 cities. We've seen a significant, I would say, we continue to see a good growth in our numbers in Tier 1 cities. It's a great business to be in, but it's also requires I think a very large team, a lot of effort. Land has become very expensive, and especially in the locations where our malls are, land has become very expensive. So I think there are many factors which deter competition. We are conscious of the fact that there can be competition. Anybody can come into these markets. So our focus is on creating such experiential centers which become dominant consumption centers. And I think with that approach, we continue to stay a little ahead of the game here. We don't see other developers building malls around our locations at present in any of the markets where we are. And we will continue to innovate, get bigger, better where we are. So, that we are just always established as a dominant center. Your second question was return on capital invested in Tier 2 cities. In fact, I must say that return on capital in percentage terms, I would say, have been even better than Tier 1. Because these are not really, they may be Tier 2 cities, but they are Tier 1 opportunities. Case in example, Lucknow, within 6 years of acquisition, we are seeing an yield on cost of about 17% and growing every year. And Indore, Ahmedabad, these also look to be very, 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 very promising. We are very keen to, go ahead full steam on our project at Surat, and it's progressing fast. We expect to see the same story that played out in Lucknow to also play out in Surat, which is a great market to be in. Ahmedabad, I would like to say that in the first full year of operations, our yield has exceeded 14%. So that's great.
Thank you. That totally makes sense. I did go to your Ahmedabad mall. It's actually fantastic. I have one more question, if it's okay. I was looking at your slide number 12, and you have category-wise growth in your consumption. So you look at electronics showing -1% or others showing 3%, food and beverage slightly lower. How are you thinking about it? Of course, you can't have a mall which has 0% of these categories, but how do you ensure that you keep pruning it and improving that trade mix? Thank you.
Yeah, that's, I think, pruning and correcting the category mix and the brand mix. I think this is very routine for us. This is how we manage our retail business. It's something that we do, I think, virtually every day, right? Looking at electronics specifically, I think it's a blip for that 1 year. And I would think maybe it's, interestingly, last year we did an electronics fest, which really, really worked well. I think this was done in Bangalore and Chennai. And we saw great turnout for that. So there are these marketing initiatives that we create for specific categories to boost their sales. And we are not seeing electronics really not getting customers. It's not like, customers have moved away from coming into physical stores and started ordering online to the extent that will impact these physical stores. I think we remain very vigilant on the performance of each of the categories, and we continue to take corrective action, be it marketing, be it engaging with them, launching some kind of a special. I would like to talk a little bit about F&B. F&B in our newer malls, we've significantly increased the percentage of gross leasable area occupied by F&B. In the new malls, we may be in about 15-16% range for F&B alone. And then you add that, family entertainment centers, multiplex and entertainment options, you're inching closer to about 30%. This is a very, I would say, strategic shift where F&B and entertainment would earlier occupy cumulatively about 15%. Now we are inching closer to about 30%. Even in our new existing malls, we are working on an upgrade to revamp, uplift the F&B brands and the options, right? So I think this drives the relevant profile of the customer also to the mall and drives overall consumption.
Thank you. Thank you so much, Shishir, and congratulations. This is indeed very well done.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that management is able to address questions from all the participants in the conference, please limit the question to 2 questions per participant. Should you have a follow-up question, we request you to rejoin the queue. The next question is from the line of Kunal Lakhan from CLSA. Please go ahead.
Yes. Question. My first question was on, what is the development plan for the 6.6 acres of land that we have bought in Bangalore?
Hi, Kunal.
Hi, Shishir.
This land is adjacent to our existing Phoenix Market City development, and which sits under the joint venture with CPP, an SPV called Island Star. So now this is exactly adjacent to that. We have the ability. We are looking at how we can amalgamate the two land parcels and be able to utilize the overall development mix in a composite manner. So it has I would say the land parcel has a development potential, including TDR of about 1.3-1.4 million square feet. We have at our existing development, we have a development potential, including TDR of 3 million square feet, and we are expanding the existing mall development. As you are aware, we are adding a 400-room hotel, Grand Hyatt. We have plans to add about 1 million odd square feet of offices. So this acquisition will help us create a much larger destination with perhaps more retail and more entertainment and F&B options. And we also have the ability to evaluate a standalone resi development should we want to take that up. The rates seem to be fairly reasonable in that area, viable in that area, profitable in that area, and in the range of about 15,000 rupees a square foot. So that is also under consideration. We are working on several options now. Since we've recently acquired this, I think we may be about 2 quarters away from deciding how we want to proceed with the development here.
Sure. Just a few thoughts there. Generally, this is very kind of uncharacteristic of us, right? In terms of we, in the past, we've generally been very clear about what we want to do, and then we have paid top dollar and bought land and built malls, and those malls have been pretty strong in terms of profitability and returns. Whereas this is this again very similar to what we are doing in Thane also, where we have bought land, but we are not sure what we are going to build over there. Any change in the thought process or strategic, thinking that versus what we used to be doing in the past versus what we are doing today?
Yeah. So with this Bangalore 6.6 acres, it was an opportunity that we had to close very fast. It came up from in our discussions with the landowners, and we didn't really get an opportunity to deep dive into finalizing a development mix. Of course, we ran our numbers basis and a base case, but we are trying to see how we can improve on that base case. And it's a little complex because the property is immediately adjacent to us.
Mm-hmm.
We have this existing mall. We are already constructing, the multi-level car park and the office towers on top of that, which are closer to the boundary of this adjacent land parcel. So we are trying to figure out what is the most efficient and I would say what is going to be the best experience for a customer here in terms of circulation, etc. So it will undergo a little bit of, it requires a lot of thought. But nevertheless, we feel that it's a huge huge value add to this development. The ability to add another 1.4 million square feet to this development, perhaps even going up higher, is a huge value add to our overall destination.
Sure. Just one follow-up on that is, in terms of we are looking at like you give an example of Bangalore also, that you may look at adding some retail space also over there. And we are already doing some expansion at the Palladium Mumbai in terms of retail space. Our earlier strategy was build these like 1 million square feet of retail was like the sweet spot. But you think that thing is changing now? Like there is potential of building larger scale malls, and we are seeing that with some of your competitors also who are building like huge malls, especially in North.
No, absolutely. I think the sweet spot has moved up simply because of the demand from retail brands and so many new global brands entering into the country. It's becoming, I think the sweet spot now is closer to about 1.4, 1.5 million square feet. And that's the goal of our expansions across all locations where we have malls operating, and also the new malls that we're building.
Sure. Thanks and all the best.
Thank you.
Thank you. A reminder to all participants, you may press star and one to ask question. The next question is from the line of Parvez Qazi from Nuvama Wealth. Please go ahead.
Hi, good afternoon, and thanks for taking my question. Congrats for a great set of numbers. Two questions from my side. First, in terms of our trading occupancy, which currently is at about 88%, would it be fair to assume that, let's say, by the end of FY25, this number would have moved to somewhere closer to the mid-90s at a portfolio level?
Oh, yeah, absolutely. Because there are so many deals done and concluded and under various stages of out. I think we should be in 95-96% range for sure.
Sure. And my second question is regarding our various office assets. Would be great if you could tell us about the status of the construction there, and when do we expect the various assets to become office? Thank you.
So Asia Towers Bangalore is nearly complete. We are waiting for the OC, and we should be able to commence operations immediately thereafter. Phoenix Millennium Towers at Pune, Wakad, these will be ready by the end of this year, calendar year. Chennai as well. So we are estimating within the next 6 months, both of these, at least phase 1 of Millennium Towers, Pune, will be ready before the end of this calendar year, which will be about 500,000 square feet. Chennai, 500,000 square feet should be ready by the end of this calendar year. The offices that we are building in Mumbai as part of our flagship development at Lower Parel, we expect this to be completed sometime in FY27. And yes, at Bangalore, the about 400,000 square feet of new offices at Phoenix Market City, Bangalore on Whitefield Road should be ready by 2026, calendar year 26.
Got it. Okay. And I mean, apart from the two acquisitions that we have done in Thane and Bangalore, how is our business development, etc., plans for new retail asset development, whether in tier 1 or tier 2 cities?
I think there are probably 2 more real transactions that we are currently pursuing, and we should be able to conclude them in this calendar year. So that would add maybe another 2.5 million to our portfolio in the next 4 years or 4 to 5 years. I had previously guided to closing 4 to 5 transactions within 24 months. This was in the last quarter call. I think the Bangalore acquisition was the first one, and there are 2 more which are underway. So I think give us a couple of quarters to be able to announce more.
Sure. Thanks and all the best.
Thank you. The next question is from the line of Atul Mehra from Motilal Oswal. Please go ahead.
Yeah, hi, good morning, and congratulations on the results. My question is in terms of the retail expansion. So, I think in the presentation we spoke about 11 going to 14. So, the question was in terms of, given our very successful in terms of response so far on the assets like Ahmedabad and Lucknow you spoke about, can we look at the next 2 to 3 years to build a very, very large pipeline, like say targeting 20 million plus in retail? Because what tends to happen is every city will tend to have a potential destination which will prosper over the next decade, right? And if we don't take that opportunity, some of our competitors might go in there, and which would mean that once they have an established asset, it would not give us that opportunity, because obviously, like, there is a limit to how much large space a city can absorb. So structurally, given also that we have a very strong balance sheet today and cash flows are very strong, can we look at stepping up the growth agenda on retail?
I think, Atul, if the estimate is to have a pipeline to target about 20 million square feet in the next few years, I think, of course, we are already at 14 million square feet with the 2-3 acquisitions that we are considering right now, plus the development at Thane, plus the extensive expansion that we're doing everywhere. I think we'll hit that 20 million much sooner.
Right.
And we continue to look for opportunities selectively in key markets. So, like I mentioned to you, I don't know if you remember this, but way back in 2017, we had told you what our portfolio is going to be. We're going to be at 14 million square feet by 2023 end, and we're going to make sure that we add another million square feet every year. So we are I think we're well on track of delivering that and perhaps more.
Right. Got it. That's good to know.
And now we are shifting gears also. Of course, we're going to be very selective, but we are looking at each development being that 1.5 million plus, So, as I mentioned in my response to
the previous question, right? And henceforth, like when you're looking at setting up, so is the template going to be 1.5 million for all new assets that you look to acquire, or it depends on like we have done in the past, a phase-wise development and maybe looking at building on assets at a later stage?
It depends on, now when we acquire land, mostly the sizing is such that you have the ability to develop much more. Even, the development regulations in all cities have changed. The FSI available is more. But depending on the demand in any particular market, we will decide on the size, and we always have the opportunity for future expansion, which we plan for right up front. So the new development in Bangalore, for example, is which is Mall of Asia, Pune Mall of the Millennium. We have also completed, we're building the mall and office at the same time. So earlier we used to build the mall, then wait a few years, but because the market is ready at these locations for the office asset class, we've decided to go ahead up front. So it's going to be customized, but the sweet spot for retail in Tier 1 is definitely about 1.5 million. We will, but depending for example, if we look at a smaller town, we may not choose to build 1.5 million up front. We may build only 800,000 and then keep a second phase development potential.
Right. Got it. Great, and thanks, and all the best. Thank you.
Thank you so much.
Thank you. The next question is from the line of Prem Khurana from Anand Rathi. Please go ahead.
Yeah, thank you for taking my question. So I mean, just if you could talk about the Indore asset a little in detail, because I mean, in terms of trading density, seems to be not there. I mean, generally when I compare with most of these other assets that we have, and most of these assets would be closer to 1,000 odd rupees sort of number on trading density side. I mean, even likes of Lucknow and the recently commissioned Pune and all. But this is more closer to 600 odd. So are we happy with this number, or is it in line with your expectation, or I mean, it's slightly lagging our expectation?
Okay, I would think that overall, what we have underwritten when we acquired this land in terms of rental income, I think we are probably there already, almost there. In terms of trading density, 600 rupees per square foot per month, you're right. But then we must also understand that the retailer's cost is lower because rentals are lower. So if you look at the occupancy cost compared to a mall which is at 2,300 rupees compared to Indore which is at 600, the occupancy cost is much lower. Yes, there is a lot of effort to be put into. It's already established, I would say, as a great destination, but we have to put in a lot more effort in bringing in great F&B options and driving other, marketing activities, etc., to drive the right profile of customer there. Rent is averaging, as I mentioned earlier, at this mall at about 79 rupees. All the other malls are averaging at about 150 or even higher. So for our model, what we've spent in acquisition and the incremental cost of construction at 750 crore, I think we are already at an EBITDA of about 86 crores for the year. This is a 11% yield. And we are quite confident it will take another 2 quarters for the, for our strategy to play out and for the consumption to start growing here.
Sure. So I think, in terms of monthly rental rate that you're charging, I agree it's lower than some of these other malls. But, if I were to look at essentially when I look at a retailer, they tend to have their cost structures in place. How much do they intend to share with you in terms of scam and rental rate? And what would you believe is the ideal number for these guys? For example, for Indore, it works out to be 20-odd% sort of number. Palladium, I can understand it's a destination of sorts. People would be willing to pay you more than 20-25% just to be able to have presence there. But generally speaking, whenever you're evaluating, what sort of number do you tend to kind of bake into your estimates to understand whether the mall would find takers or not?
Hi, Prem. Varun this side.
Yeah.
So, just taking that question on Indore, I think, one thing that does not come out when you look at a retail mall is the tenant mix that you have with each center. So, Indore, for example, has today lower anchor area than what you would see even in a Gurgaon or a Pune or a Bangalore, and that has been a very conscious strategy. Driving more inline centers and creating more space for F&B and family entertainment centers actually drives a stickier profile of the grade A consumers that we are targeting. And because the anchor area is lower in area in Indore, cost of occupancy can actually be higher than what you may see for, established centers like a Phoenix Market City in a Bangalore or a Pune or Chennai, which are at about 13-14% rent to consumption.
Sure. Thank you, and that is all the very best for future.
Thanks.
Thank you. The next question is from the line of Mohit Agarwal from IIFL Securities. Please go ahead.
Yeah, thanks and congratulations to the team for a great performance. My first question is, we talked about Tier 1 malls. So just for your expansion in Tier 1 metro cities, we have so far taken the greenfield route for constructing new malls, but given the land availability issue, would you be open to or have you considered exploring the brownfield or acquiring existing malls and turning them around? And would your valuation expectations be very different when you're acquiring a brownfield mall? So that's my first question.
Yeah, I think, generally we look at greenfield developments resulting in a stabilized yield let's say in the third year or fourth year of operation, we look at trying to be closer to 18-19% kind of a yield on cost. So that's where we find the real value for us. Buying operational malls, the opportunities are very, very few because there aren't too many great malls that meet our specs for us to acquire. We are always open to acquiring brownfield assets. Brownfield assets also, our experience with, let's say, Lucknow has been fantastic, where we acquired it at a great price and we were able to take it to completion in a very short span of time and make the mall operational. So we are open to brownfield. Greenfield is clearly what we do. Operating malls, as I mentioned, there aren't too many assets that we can look to buy. The ones which were available for sale have already been purchased by several of the funds, as you know, or the REITs. And the returns are very, very low. So that's really not our principal strategy.
Okay, understood. That's clear. And secondly, on the commercial bid, you gave timelines on the completion. So between Bangalore, Millennium Towers and Chennai, in the next 6 months, we have almost roughly about 1.5 to 2 million square feet of space coming up. What is the leasing pipeline looking like in these assets?
So this is about 1.6 million square feet. We have started the soft leasing at Asia Towers, Bangalore, and I think there's been a lot of interest. We've seen it, despite North Bangalore being a slightly soft market, we've seen a lot of inquiries and interest in this asset. I think we'll see a great traction as we get our OC in place in the coming months. Pune, Millennium Towers and Chennai, we've not yet started leasing, but we've started inviting, potential leads. And again, I would say there's a reasonably good inbound interest from a lot of tenants in both these markets.
Sure. Thanks. Those were my questions, and congratulations to Mr. Gupta on joining the team. Looking forward to interact with you.
Thank you so much.
Thank you. As that was the last question, on behalf of the Phoenix Mills Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.